U.S. debt credit rating downgrade. Confused? What is it? What does it mean? Has that happened before? If so, what happened last time? What should I do? Well, let's find out. What are credit rating agencies? Credit rating agencies provide ratings of creditworthiness of debt interests from sovereign nations, municipalities, corporations. Majority of the time, they are types of bonds. The ratings are used by investors to assess the creditworthiness of the debt, how likely they are to repay debts in a timely manner. The ratings are basically like a credit score on the issuer of the bonds. So if you're the bondholder, will you get your money back and interest that is to be paid to you? Well, is it like my credit score? The credit rating is distinct from consumer credit ratings. Consumer credit rating companies pertain to the creditworthiness and default risk of individuals. Both ratings aim to assess the creditworthiness and have financial implications for lenders, investors, and consumers, but they are separate in their focus and scope. The U.S. credit rating system is more appropriate for macroeconomic indicators. The four major credit rating agencies are Standard & Poor's Global, Moody's Investor Service, Fitch Ratings, and Kroll Bond Rating Agency. Consumer credit ratings only apply to individual financial situations like Equifax, Experian, and TransUnion. Unlike consumer credit, where scores are numerical, the bond rating system is expressed through letter grades. Higher grades represent lower credit risk and better creditworthiness, just like higher personal credit scores are better than lower scores. How many times has the U.S. debt rating been downgraded? Three times in history. In 2011, Standard & Poor's downgraded the U.S. credit rating from AAA to AA+. In 2023, Fitch Ratings downgraded the rating from AAA to AA+. In 2025, Moody's downgraded the rating from AAA to AA1. In 2011, Standard & Poor's downgraded the U.S. credit rating from AAA to AA+. On August 5th, 2011, the S&P noted the following when it issued the downgrade: effectiveness, stability, and predictability of American policymaking and political institutions, as well as an insufficient fiscal stabilization plan for the medium term. They further stated, our opinion is that the elected officials remain wary of tackling the structural issues required to effectively address the rising U.S. public debt burden in a manner consistent with a AAA rating and with a AAA rated sovereign peers. On August 1st, 2023, Fitch Ratings downgraded the rating from AAA to AA+. Fitch stated the repeated debt limit political standoffs and last minute resolutions have eroded confidence in fiscal management. In addition, the government lacks a medium term fiscal framework, unlike most peers, and has a complex budgeting process. Fitch further cited the nation's high and rising debt, the lack of a plan to address the drivers of that debt, and the erosion of good governance. On May 16, 2025, Moody's downgraded the U.S. rating from AAA to AA1. Moody's said the following on the downgrade: Successive U.S. administrations and Congress have failed to agree on measures to reverse the trend of large annual fiscal deficits and growing interest costs, as it changed its outlook on the U.S. to stable from negative. A credit rating downgrade can impact the economy, potentially affecting interest rates or government securities. Now, does that mean you panic? No. What should I do? Well, successful traders treat trading as a business. Professional traders treat trading as a business of probabilities. They use the data of what happened in the past to understand what can potentially happen. Let me be clear on something first. Nobody can predict the future with 100% accuracy. And I mean nobody. We take past data and what happened before to see if we can possibly profit from that price movement, hedge our portfolios, or simply sit out and wait for clarity. In 2011, SPY gapped down and closed 6.51% lower. SPY was range bound for approximately 147 days before breaking to the upside in January 2012. When price held above the anchored VWAP from the gap down and the 50-day moving average began sloping up, the SPY really broke out into a bull run once price was above the 200-day moving average. In 2011, QQQ gapped down and closed 6.02% lower the next day. QQQ was range bound for approximately 162 days before breaking to the upside in January 2012, when price held above the anchored VWAP from the gap down and the 50-day moving average began sloping up. The QQQ also broke out into a bull run once price was above the 200-day moving average. In 2011, the Dow Jones Industrial ETF (DIA) gapped down and closed 5.41% for lower the next day. It was then range bound for approximately 154 days before breaking to the upside in January 2012, when price held above the anchored VWAP from the gap down candle, and the 50-day moving average began sloping up. Then later in June 2012, came back to test the same anchored VWAP, breaking out again to the upside. The Russell 2000 ETF IWM gapped down and closed 8.71% lower the next day. It was then range bound for about 169 days before breaking to the upside in January 2012, where price held above the anchored VWAP from the gap down candle, and the 50-day moving average began sloping up. But then later in June 2012, and again in November 2012, came back to test the same anchored VWAP before breaking out again for a solid bull run. In 2023, SPY gapped down the next day 1.4% and continued to drop 10% before bottoming. It took SPY about 104 days to recover and then go on a bull run. Triple Q gapped down and closed the following day 2% lower and continued down for another 5% before a short-term bounce occurred, but continued to drop a total of 10% in 2023. It took QQQ approximately 105 days to break to the upside on a bull run. The Dow Jones Industrial ETF gapped down and closed the following day 1% lower and continued down for a total 9.4% with a few bounces along the way. It took DIA approximately 121 days to break to the upside on a bull run. The Russell 2000 ETF IWN gapped down and closed the following day 1% lower and continued down for a total of 18%, with a few bounces along the way. It took IWN approximately 141 days to break to the upside. So, where do we go now? Well, looking at everything I just showed you, it seems we are due for a pullback at least, if not a correction based on the past. Now, how far we go, nobody really knows for sure. I believe we will gap down lower on Monday. I would keep an eye on the 5-day moving average to give you the short-term trend, Particularly pay attention to the slope. Potential areas of interest to watch price action. On all three major indexes, I would watch for a test of the 200-day moving average. If price fails there, then I would look to the test the 50-day, which in all three of the indexes, the 50-day is below the 200-day. IWM seems much weaker as it's still below the 200-day, and I would look for a possible test of the 50-day moving average immediately. The downgrade late Friday came after market close and sent yields on Treasury bonds higher. And S&P 500, Nasdaq, Dow Jones, and the Russell 2000 all dropped in after-hours trading. Keep in mind, we are still in a very headline-driven market. Any good news could make us rocket, or any other bad news that could come out could send us tanking. Do we get a slight pullback and range for a while like in 2011? Or do we get a deeper pullback and then try to bounce like in 2023? Or do we get something completely different this time? Hard to say. Speaking data-wise, it's only happened 2 times before, which is not enough data to statistically say. Plan ahead, manage your risk, trade what the chart is telling you, not what you want to see. Good luck. If you're interested in one-on-one coaching or have some specific questions maybe I can answer, here's my contact info. Feel free to reach out on Discord, email me, or book a one-on-one coaching